Morning, everyone, and thank you very much for joining me. This is the morning market review. My name is Russell Shaw. I'm a senior market specialist at FXCM, and my email address is rshaw@fxcm.com. Of course, if you need to reach me throughout the day, that's the email to use. Today is Monday. It's the 13th of June, 2022. Let's go ahead and bring up our high-risk investment warning. I'll keep this on screen for a few moments. And then we'll bring up the commentaries disclaimer. Hey Howard, morning to you. Nice to have you on the webinar. Yeah, I had a very good weekend. Hope you did as well. Hey Rob, morning to you. Hope you had a good weekend. Hope everyone had a good weekend and is ready for this week. I think that it's going to be a very, very interesting week on the market. And let's bring up our market commentaries disclaimer. And our references here, MarketScope 2.0, CNBC.com, TradingView.com. CNBC we're going to be using. We'll just go through the morning European article just to get an idea of what the big headlines are, and then we'll I think then we'll defer to TradingView and the MarketScope. So the European market headline is European market set to slump as the prospect of rate hikes cloud investor sentiment. European stocks are expected to slump at the open on Monday as investor sentiment is dominated by the prospect of forthcoming interest rate hikes. The slump in sentiment expected in Europe on Monday comes after the region's major bourses closed in negative territory last Friday, with the investor mood darkened by the European Central Bank's confirmation last Thursday that it intends to hike interest rates by 25 basis points at its July meeting. A further hike is expected in September, the scale of which will be determined by the medium-term inflation outlook. The central bank also raised its inflation expectations for the Eurozone significantly and downgraded its growth forecasts. On Friday, US inflation data compounded the losses, with the highly anticipated May Consumer Price Index report coming in hotter than expected, with US headline inflation hitting 8.6% year-on-year, outstripping economists' expectations and the previous month's figure. Overnight shares in Asia tumbled on Monday as major markets in the region saw sharp losses and the dollar-yen hovered around the 135 level. Meanwhile, US stock futures fell Sunday night as Wall Street tries to recover from one of its worst weeks of 2022. There are no major earnings or data releases today. All right. Let's start off with the analysis on TradingView. I think a good place to start is the 10-year. Let's bring in our RSI and our stochastic here. I think it's going to help. We're looking at a weekly time frame. Let's bring in the stochastic first. Okay, and let's bring in a relative strength as well. All right. Let's work from the price chart to the stochastic to the RSI. So let's just focus on the trend. Okay, trend is defined by peaks and troughs. Okay. Okay, so we've got to just put this in over there. That goes in over there. All right, let's just take a look now. So the high that we reached, take a look here at the H. Okay, so the high that we reached in this last up leg was 3.203. 3.203. This one is 3.178. 3.202. So we still, yeah, we're very close to it, but we haven't made a, we actually haven't made a higher peak yet, not yet. So what I'll do is I will put in HP question mark, and we will just see if we go over that. I would expect that we're going to comfortably move over this. Why would I think that? Well, we've got the rate hike decision on the 15th. So in 2 days from now, we're going to get the Fed. I think it's worth just saying a few things. I think the Fed has been, I think they've been useless, dare I say. So I don't think that the transitory inflation was a debate. The transitory inflation was a debate, and we were coming out of the pandemic. It was very difficult to get any sort of I think real directional bead with any sort of certainty. So there was a debate. I think that by and large the market saw that inflation were the market saw inflation as more sustained, and the Fed saw it as transitory. And then in the end of November last year, they retired that word transitory. It was way too late. The damage had been done. Okay, so we had a huge monetary expansion at a time when inflation was running absolutely rampant. It was a miscalculation. And not only was the monetary policy ultra loose, the fiscal policy was also ultra loose. So it was a double, sort of a double injection of inflationary pressures, which is before we even saw the supply shocks due to the invasion of Ukraine by Russia in February. So we were already starting to get some severe readings on demand side inflation, exacerbated completely by supply side inflation, which is a separate argument to the Fed's misreading of the transitory. But I think that in of itself can be forgiven because it was a debate. All right. In hindsight, the Fed was wrong, the market was right. Okay, that's just, but let's forgive that. What I think is, what I've said before, schoolboy error is taking 75 basis points off the table for June and July. That's just stupid. I can't think of another word. It's just plain stupid. You don't limit your toolbox. Okay, you don't limit your toolbox. We need a 75 basis points cut on Wednesday. That's what we need. And we may get it. The Fed may be forced to deliver 75 basis points. But if they deliver it, then why would you communicate that you're going to do 50, right? So there is there's an error there. Let's say they deliver the 50. Okay, well, there's an error there because you need 75. So they kind of shot themselves in the foot. You don't do that. I mean, it's stupid. And then what about July? So let's say they do 50 basis points. Let's say they do 50 basis points on Wednesday, which in my opinion they have to do to have any sense of credibility. You need to do what you say, right? But in this case, if they don't do what they say, they're doing the right thing. They've just shot themselves in the foot. There's no win here. Okay, so let's just say they deliver 50 basis points. Okay, well, 75 basis points is almost then they sort of facto for July. I don't think they can get away with a 50 basis points in July unless next month's CPI figure does some sort of miracle turnaround. But then again, why would you take that off the table in communicating that June, July is going to be 50 basis points? It's schoolboy error. You don't do that. You keep, you need to be very careful on that level with your communication with the market. The market now is confused because we need a 75 basis points. We get a 75 basis points. They've done the right thing. They've completely miscommunicated previously. They deliver 50 basis points. They're keeping in check with the communication. They've completely done the wrong thing in terms of monetary policy. Gee, that's a terrible position to be in, right? All right, they did it to themselves. All right. Let's take a look at the. Let's take a look at the stochastic. So as long as the stochastic stays above 80, we're going to see interest rates move higher. Okay, because there's no such thing as overbought in the stochastics. No such thing as overbought in the stochastic. The stochastics is pure momentum, pure momentum. So if we're in the upper quintile here and we continue to stay in the upper quintile, we'll continue to move up with rates. Okay, so we go back to this leg, you can see what I'm talking about, right? There's the movement. It's only when we come out of the upper quintile that the rates moderate. So we need to get some sort of moderation in the stochastic in order to have a wane in the momentum. Momentum is extremely strong now, and we're not overbought. But we're tending towards overbought. Okay, we're tending towards overbought. So the fact that we're tending towards overbought, I don't think we have. Maybe we go sort of to, dare I say, towards 350 before we kind of get the next pullback, the next higher trough. Remember what's happening here. Forget about the rate hike, which we desperately need. Okay, we're getting a contraction in money supply, which is going to make interest rates adjust upwards. Okay, so that's the 10-year, right? Yeah. Okay, Indra, I think you are referring to the time value of money. Sorry, I'm not sure if you can hear. Somebody's using a hacksaw outside. I'm at the office, but someone's using a hacksaw. I apologize. All right. That's the 10-year. Is there anything else we need to do here on trading view? I think we just need to take a look at inflation on trading view. So let's get rid of our oscillators. All right, let's take a look at PPR first. So we need to see a moderation in PPR. So what you want to do is you want to put in the code US PPI year on year. I think that's the one that we use. Let's just take this off logarithmic. All right, so it has turned over here. It has turned over here. That is a positive. But this is supply side inflation. It's not much that it can do about it. But we do need to see it come down because I think there's a causality here. What we just got to be careful of, if I bring in the previous stagflationary periods, let's just go here. If we go through to the previous stagflationary period, so this is the so these are the previous. Here's the first oil crisis, the second oil crisis. What we got to be careful of is, so yes, we're seeing the PPI hinge. Okay, we're seeing the PPI hinge. That's a good thing. Okay, that's a good thing. But it needs to continue downwards. So if we take a look at the previous stagflationary periods, there is a trend here. So it does peak and trough. So the fact that the PPI is hinged here, that's a good sign. That's a good sign. But as long as it doesn't form a higher trough and then move up again, which there is, of course, a possibility, right? Because we know that the supply shocks are ongoing. We're in the midst of a real disruption to supply because of the conflict. So we just want to watch this very, very carefully. And then what I think to do here is bring in the core inflation, just to see how core consumer inflation interacts with the producer price index. And the way that we're going to do that is we'll just bring in US core CPI. So you just press this plus over here. And we're going to use, I think it's this one. It is that one, but I've got to put it, I want to overlay it. Yeah. So this orange is the core. That's the core CPI. So core CPI tends to track the PPI in these sort of stagflationary periods. And you know, the question is, well, what is the reason for that? I don't think that we can just take a look at the series and say that's kind of the rule. I think we've got to try and come up with some sort of theory for why core, which is on the demand side, will follow the supply side up. And I think the answer there is the wage inflation spiral. So typically what I think is happening there, and again subject to correction, is that, you know, all of us are feeling the pinch of the higher producer prices, because it does get passed on to consumers. So the way that it would work is if for a manufacturer, they're sourcing their inputs at higher prices, they've got to choose whether they're going to absorb those prices or they're going to pass them on. One way or another, they eventually get passed on. So if they get passed on to us, when we go into our wage negotiations, we negotiate a higher wage. The companies that we work for, they're also passing on higher costs to their customers. So they generally would, I think, to a large degree, I'm not going to say bend to our demands, but understand our demands. So they might not give us as much as we want, but they'll give us an increase, which of course we go then and look at the inflation. The inflation carries on going up, so we want to perhaps bargain and get our wages up again. And there's a spiral, and that's what the Fed has to stop, because that's a very dangerous spiral to get. That can really cause serious inflationary pressures. So you want to just nip that in the bud very, very quickly. So I think that's the explanation here in a stagflationary environment. And again, I haven't read much literature, and it's just kind of what I'm inferring. But I think that is what's happening, and I think that's what's happening now. So what would be the best scenario for us would be actually to get the core, to actually get the core underneath the PPI, some sort of cross. So I'm just kind of see we're kind of there, I suppose. The question is, are we going to get CPI above PPI? We need to see these guys come down, which of course then brings us to, I think, a very good way to look at inflation. And we've looked at this very, very briefly, but I think this is the best way to look at it, again, in my opinion. So we just go CCPR. So in other words, we're applying technicals to a fundamental reading, and I think that's okay. I think applying technicals to fundamentals is actually a really good thing to do. I've been thinking of writing an article for it, but on it, but haven't done much about that. So what we want to take a look here in terms of core CPR is we want to apply technical indicators. Well, we're in a trend. Okay, so we're in a trend. I think everybody would agree that we're in an uptrend. So if we're in an uptrend here, it would make sense to use trend following indicators. Well, the most widely used trend following indicator is a moving average. So we can just apply a moving average. Now, because we're using a monthly, let's just use a 12 months, and we'll use an exponential just so it's a slightly faster moving average. So let's put that in, EMA, and we'll just put in a 12. And what we can look for here simply is a crossover, just a normal technical analysis signal. And that is yet to happen. So the crossover from below the 12-month moving average, I think, is sort of in retrospect, or in hindsight, a good signal. The problem with this is, of course, we are going to be quite late. So the CPI has already peaked. We've already peaked there. And that's the problem with moving averages, is they tend to lag. So we want to just perhaps see if we can get a better reading, sort of a more timely reading. And what I think we can do here is we can add in an RSI. And what we're going to do with the RSI here is we're going to add in a moving average onto the RSI as a trigger. So just take a look at the readings that we're using. We're using a 10 high low 2. I'm going to add in RSI based moving average. Let's make it a black line so it's easy to see. Now signal lines are generally 9. Okay, generally 9. I'll just make this an EMA. Okay. And what you can see here is we get a slightly better reading, I think. So it crosses just there, crosses there. So we're getting a slightly better reading. Take a look at what's happening to the RSI. It's actually hinged. Isn't that interesting? So the RSI is hinged. So what I think is happening here is that we are near the apex. I think we are near that apex, right? But we haven't peaked, or the market was calling for a peak before it peaked. Now there's panic, right? Now there's panic. Well, if we cross over here, again, then I would suggest, we're probably kind of near the peak. So I don't know if we've peaked or not, but let's just get the signals in here. Let's not call a peak until we can really have some evidence of a peak, right? So we might have peaked. I don't know. That would be really a blessing for the Fed, who's just completely mishandled this. So that's kind of the analysis we'll do going forward. Let me just see a few comments here. Can the Fed get away with a lower rate rise and a higher QT? From Rob. Yeah, I think they could probably. But I'm saying that, Rob, I'm saying that sort of as ignorant of quantitative tightening, but I'm not in a bubble here. I think most people are ignorant of quantitative tightening. The fact that we have such huge inflation is because of a cause-effect relationship between inflation and QE. It was grossly underestimated what unlimited QE could do. Well, QT's got the same risk, right? So there's risks that we don't know about, I think, that are associated with QT. So whatever we think is going to happen here may or may not happen. So I think that needs to be acknowledged. I think that siphoning liquidity out of the economy will certainly cool the economy. I think will certainly cool the economy. So now the Fed has to manage their QT with their hiking cycle. I don't think that they are. I don't think they're doing a good job at the moment. But I would say that they probably could if they. And I mean, these are PhDs in economics. You would expect them that they'd be able to come up with some sort of model to do it. But does that answer the question there, Rob? So my answer to this probably, but I don't know if it will happen. I think they kind of don't know what to do with their rate hikes. All right, let's just go through to some charts here. All right, so starting off with the US 30, which is the Dow Jones, you can see the issue here right away. Take a look at the peaks and troughs. Low peak, low trough, low peak, low trough, lower peak. Okay, that last week was effectively the lower peak. Look how close we are to the next lower trough. Now, there's a lesson here that we consistently see in bear markets, and it's consistently ignored in bear markets. And that's that the bear market doesn't do the damage. It's the bear market rallies that do the damage, isn't it so? And that's what we saw in 2008. So look at this. This is a huge week over here. This is a huge week over here. Market participants desperately trying to get back into the market. Well, whoever bought at the high, you know, is crying now because they've just been hammered by the bear market rally. So that's where the damage gets done, right? That's where the damage gets done. Now, what we want to do is we want to just follow the peaks and troughs, I think, because we want to get some sort of measuring tool in terms of bear market versus bull market. And I think it's worth just bringing up Microsoft Paint here. Anna writing here, Schiller's narrative economics can be heard on YouTube. I listened to the first chapter yesterday about Bitcoin. Very interesting. Would recommend the book. Okay, I haven't read it, of course. Schiller's narrative economics, is that the title there, Anna? If you have a link, share it. I'll send it through to everyone. But yeah, I mean, absolutely. The idea with trend analysis, I want everyone just to acknowledge the fact that trend analysis is lagging. You won't know the bottom, you won't know the top of trends. People have tried for 100 years and no one succeeded. Okay, so what you want to do is you want to acknowledge that you're going to have, okay, you're going to have a movement that does something like this. All right, so here's the bottom, eh? Here's the bottom. And you can see this is actually a head and shoulders bottom, okay? But forget about the head and shoulders bottom. Look at it in terms of peaks and troughs, okay? Because that's really what a head and shoulders is. It's just peaks and troughs. So we put in a reference trough here, and we put in a reference peak here, and we put in a higher trough here. Okay. Now we've got a hint that there's some strength coming in, but it's only really when the peak is taken out over there that we have an uptrend. Okay. So until that happens, the bear market rallies are effectively very dangerous, sucker rallies, right? So we need to get our peaks and troughs right, and not fall into the trap of bear market rallies. And at some stage, there will be a bear market rally that actually is not a bear market rally. It actually turns out to be the first leg of the bull market. We're just going to have to accept we're going to miss that. You know, we're going to miss that because the bottom is not really important. It's the bulk of the trend that's important. Okay. you just want to get in pretty close to the bottom at a sensible level, and assuming the next trend is a trend like this, let's just assume, well, that's fine, because you won't get out at the top either, right? But if you can take this, out, well, that's a success. That's a 10 out of 10. Understanding that we're not going to get in at the bottom, we're not going to get in at out at the top. It's impossible, because we don't know where the bottom is, we don't know where the top is. If I had to bring up this chart and ask you guys, is this the bottom? Is the price we're seeing right now the bottom? Well, none of us know, but the truth of the matter is it's a possibility. You know, nobody in the world knows if we're at the bottom now, but it's a possibility, right? So we're just going to have to accept that one bear market rally is going to turn actually into the first leg of the bull market. We're going to miss it, but we'll catch the rest of the move. All right. There is a very good indicator that will help us, and that's the COPOC. Now, again, it's not something that is widely used to my knowledge, and the people that I do know that use it don't use it well. They use it incorrectly. But let's just go through to the US 30 here. So you want to use it on the monthly. Let's get rid of this guy, and let's bring in the COPOC. Now, because it's a monthly, and we're only on the 13th, we really need another 2 weeks to get a good reading for this month. But we still can move down, because we're looking for it to go below zero. Now, again, it doesn't mean we have to go below zero. That's not what the COPOC's telling you, but it does saying once we go below zero, we probably add value. We probably add value. Then we want to look for it to turn out, but we're not below zero yet. So that's just a warning sign right there. Let's go through to DAX. All right, so guess where DAX gets hammered? Right at our level, well, pretty close to our 15,000, right? Which we said is always going to be a tough level. It's looking obviously much stronger than the Dow. The Dow has got lower peak, a series of lower peaks, lower troughs. The DAX doesn't. The DAX actually has a higher trough here, and it's got a lower peak here. So let's get rid of this, and let's just revise the analysis here. All right, so this is interesting now, because we've got peak, low peak, trough, higher trough. So what this actually is not a trend. So if you've got a higher trough followed by a lower peak, that's not a trend. That is actually a pattern. And higher trough, lower peak, well, that's a triangle, right? So we on the DAX, what we have now is a consolidation pattern. Okay, but here's the danger: is that we've broken below the lower boundary of the consolidation. So it's a weekly chart. We only found out on Friday that it's a triangle pattern. In other words, the volatility is sort of heading towards an apex. You know, it's converging towards an apex. But we only so there's an example of the lag, but the problem is we've broken below it. Okay, so we just want to watch it, and we've gapped below this this lower boundary. That's again not what you want to see with patterns. If they break down, they tend to be continuation. If they break out, they tend to be reversal, right? In this case, so we'll just keep an eye on that. Let's go through to the daily here, and you can see that the daily now has moved into zone 3, and look at the Bollinger's pulling away. See the explosion in volatility there? Now, if that volatility continues and we stay in zone 3, bear market continues. So you can see the danger right there, which of course brings us through to the hourly chart here. How do we get involved? It's difficult. It was difficult on Friday because we were already late in the move. Well, the stochastic kept under 20 and the market kept going down. It's very difficult to get in short when the move is so late. You're really counting on the momentum staying at the lower quintile, and I'm not certain, you know, that's going to happen. But what I would suggest, if there is any sort of rallies here, I would look at the pivots for potential resistance. Now, just before we sign off, thanks, Anna. Okay, I'm just going to post this. Okay, this is the link to narrative economics. Thank you very much. Okay. Oh, okay. Anna's just asking for dollar. Yeah, let's do dollar. All right. We'll do dollar, and then what we'll do, is go back to Indran's. He just asked if we can do the time value of money calculation, which we will do. Let's just do dollar before we do that. All right, so it's very much a function of the US 10-year. So we are strongly, there's a strong underlying momentum. Okay, there's a strong underlying momentum to the upside. We are tending towards overbought. We're not quite there yet, and we've got the higher trough, and we're waiting to see if we get the higher peak. I would suggest we do get the higher peak. I think that the meeting on Friday has to be a hawkish meeting, right? So we'll put higher peak question mark, but look at the peaks and troughs here. Okay, it's just we'll get quite loose. All right, and here's where we are now. All right, so then you just go through to your daily. Well, let's look at the daily here. We're in zone 1. Okay, so we moved from zone 3 into zone 2. Now we've moved from zone 2 into zone 1. Take a look at the Bollinger starting to pull away. Now, if the volatility is building, as this suggests, and we're heading towards a very important FOMC scheduled release, I think that if it stays in zone 1, it's very likely we see higher dollar prices ahead. And we've got a similar problem here, I think, with the then we have with the DAX is we're late in the move here. All right, so if it pulls back to central pivot, I think that would be quite well supported. But of course, if the market sentiment keeps us above 80, well, we'll break above the R1. So there's the conundrum. Do we break above the R1, or do we get an opportunity to get into this in terms of a dip in an uptrend, right? Rob's saying there's a lot of options expiring at the end of the week, which could cause a rally and a potential entry point. Okay. Let me do a little bit more work around that, Rob. I don't want to comment. It's not something. Yes, I think that the options expiry will cause volatility. Just want to do some more work around that, but I would agree. I don't think I can add anything more than that, so I'll just read it again. There's lots of options expiring at the end of the week, which could cause a rally and a potential entry point. So bear that in mind. And I would also just suggest, besides the options, which of course could cause market movement, just remember right in the middle, we've got that FOMC meeting. That's going to be huge. So just watch for price action before, watch for price action after, watch for risk during. Okay, so just be cognizant of that. Anna's saying, yeah, and the candle is even outside. It's even outside of the Bollinger Band. So the volatility there is obviously quite stark. Any questions around that? Just type those in, and let's just go through the time value of money. I'm not going to get into the calculations too heavily today, Indra. I learned my lesson last Monday. But there's I think the way that we must explain it is there are two directions for the formula. One is called compounding. I think we all know what compound interest is. Okay, compounding. And that's basically working out the future value of. So let's just say if you want to work out, let's say you got 100. Let's say you've got $100. That's called the present value. So you'll take your $100, okay, and then you'll use the interest you're receiving. Let's say you're putting it into a bank account, and let's say they're offering you R%. This is the formula, but then depending how long you are going to hold it in the bank for, let's say you're going to hold it for 5 years, it will be to the power of 5. Now, there's a huge simplification in here, okay, in that what happens if we compound it monthly? What happens if we compound it every 6 months? That we haven't included into this formula, but that's the formula for compounded. But we've got another part to that, and that's called discounting. And discounting for us is more important because we want to know effectively what the present value is. So we don't really want to know what we don't want to know that if the $100. We don't want to know what the $100 is. We don't want to know if the $100 is actually worth $100. Okay, if we kind of can discount future values. So let's just say we are expecting to have $200 in the account at I percent. The formula is actually like this. All right, and that would be your discounting formula, kind of something like that. So, and remember, Anna was asking, but I don't know how the discounting works. The discounting happens immediately. It depends if the expectations for future value changes. It changes if the expectations for interest rate changes. Even if the time period changes, any one of these variables change on the right-hand side, then the left-hand side has to discount to reflect that. That's what discounting means. Okay, so these are the two formula, Indra. I don't want to go much past that today, just because last Monday, you know, it was a little early in the week. Perhaps sort of tomorrow or Wednesday. Does that help, Indra? And just let me know. So we're not going to do Bitcoin or Ethereum today. We're going to do that on Friday. There's actually a compliance reason for that. So we're not going to do that now, but we will do it on the. We're going to do that on the Crypto Minute on Wednesday. So look forward to that then. What I can say, of course, is that the strong dollar is wreaking havoc on the crypto markets at the moment. All right, guys, I think that's where we're going to leave it for this morning. If there's anything else, you can, of course, email me. I want to wish you guys. Yeah, okay. I think we better arrange some sort of Friday webinar, Anna. She's just asking if we can do it in more detail. and we can do it in more detail. Let me figure out how we're going to do it. All right, guys, let's wrap up here, and let us let's meet again tomorrow. Have a good day, good evening, and we'll chat tomorrow. Cheers, guys.